All right, Robert. You are free to go, sir.
Appreciate it, Marcus. I'd like to first say happy summer to everybody. Hope everybody's staying cool in the boiling heat and humidity. We always say greetings and salutations, and thank you for coming out and spending some time with us today. We always appreciate the opportunity to educate and illuminate our clients. This is about shedding data, but making sense of it and how it relates to you and can help you more better prepare going forward for your financial goals and objectives and the things that you're trying to accomplish and things that are important to you. So let's start first with the good news, okay? Through July the 10th, year to date, the markets, the S&P 500 up 11.4%. The Dow Jones Industrial Average up about 10.5, and the NASDAQ up about 13.4. Now, that sounds great through the first 7 months, but it wasn't without some ups and downs and some trepidation with some of the conflict going on in the Middle East with Iran and the U.S. and Israel. So let's go through first off and highlight some key data points that we think are important. Number one, unemployment is still relatively good. It's 4.2%. Haven't seen any big spikes in that, so we'll take that. Good market performance. Unemployment numbers that are relatively low. We do want to point out that going forward, while we're having this particular Zoom tonight, is because we anticipate the back half of the year may be a little bit more of a roller coaster ride and more volatility is anticipated between geopolitical events, the recommencement of hostilities in the Strait of Hormuz, and of course, midterm elections. So we anticipate that the back half of the year will probably be a little bit more volatile than what we've seen through the first 6 months of the year. So again, it all comes down to the Strait of Hormuz. Right now, inflation through the month of May, year over year was 4.2%. But in June, believe it or not, it dropped to 3.5%. So that means the Fed may pause. They're not going to cut rates, but they may pause their rate hiking cycle, which may commence. So the Federal Reserve right now, the thought is that the next move they make will be up, raising rates, not lowering them, but they may hold off here for the month of July. We'll see. Mortgage rates were about 6% in February. Today, 30-year mortgage rates are 6.64 on average. So we're going to keep an eye on that, how it impacts the housing markets. Gas was $2.98 before the war. It peaked at $4.50. Now we're down to about $3.89, and that's before the hostilities recommence. So we have to see how that plays out. That is the big X factor. For our Social Security recipients out there, cost of living adjustment next year expected to be 2.7%. We don't know, but somewhere between 3.7 is what AARP is expecting. Not 2.7, but 3.7. So we'll find out shortly how that plays out. But the next Fed move we anticipate will most likely be a move up if inflation proves to be stubborn. I want to take a second to highlight one of the key things we always talk about is making sure you have a plan, not abandoning it, but rather adapting and improvising that plan. And here's why I'm telling you it's so important to have conversations with your advisor. Recent study was done, 2026 U.S. retirement survey of 1,500 savers and investors nationwide from all different socioeconomic backgrounds. And what they found was that 31% of plan participants, meaning 401k savers or employer savers in an employer plan, 3 of every 10 had no idea, I repeat, no idea how their money was allocated, meaning was it all in cash? Was it all in bonds? Was it all in stocks? There's no communication with an 800 number. 3 in 10 people are walking around clueless. They're sleepwalking. That's why Michael's on this Zoom tonight, Marcus is on the Zoom, and I am, because this is what we try and do each and every day, making sure people have a better grasp of how to move forward and plan for their finances, because to not have any clue how your retirement monies are allocated doesn't make sense. If you don't have a map of where you're going to go, you even know where you're going. And so I think that is a key thing. But going forward, in closing, there's one key thing I want to talk about, and it's called concentration risk. Concentration risk. And what I mean by that is not orange juice concentrate, but rather when people save and when they invest. And this is what I mean by this. Listen to this statistic. The 10 largest companies right now in the United States, represented in the S&P 500, the 500 biggest companies, they represent 40% of the value of all the stocks in the S&P 500. Just 10 companies out of 500. That is close to an all-time high. You have to go back to the 1960s to find a comparable time. When we look at that, we look back in the 60s, we had a situation where back in the 60s, you had close to 3 or 4 major oil companies that controlled an outsized amount of the value of the market. The concern there is that if everybody's investing in the same thing, you're really allocated. It gets back to that same thing. We believe in owning good companies. You just had to have so much of your basket in 1 or 2 eggs, if you follow what I'm saying. And that's the highest level since the mid 60s that we're seeing in terms of concentration. And you got to be careful there, because it starts to become a situation where you don't have a lot of exposure to other assets. So it's a great time to relook at your portfolio and making sure you're not just concentrated in the FANG. Basically Amazon, Netflix, Google, that you have exposure beyond that, because there's other great companies out there in America. And I give you the final reason why I say that. In the 1980s, the Japanese stock market accounted for 44% of the value of all the stocks around the world. Today, they account for less than 5% of the value of all the stocks in the world. So just think about that. You don't ever want to have all your eggs in one basket. And when everybody's moving and acting and thinking the same, there's an old adage that means nobody's thinking. And so what we want to do is add a different perspective and help our clients move forward. So always remember to have a plan and adapt and improvise the plan, but the call to action must be never to abandon the plan and revisit where you're at and what you're doing. Back to you then, Marcus.
Man, Robert, you always have a wonderful way of summarizing exactly what we're going to go through. A lot of what you shared is exactly what Mike and I will be giving more of a visual explanation to. So thank you so much for starting us off with that. I'm going to just start off with the quick introduction. Hopefully you can see. So correctly, you're familiar with all of us, Mike, Robert, myself, Marcus, rather. Your trusted advisors located in the Richmond office of Cetera Investors, 140 East Shore Drive, Suite 105. The 3 themes, and I'll pass this off to Mike to start us off with the first theme. At the beginning of the year, we believe that we could see a stronger than expected economy. It's very important that I'm enunciating these words, because there is a difference between the economy and the market, right? Oftentimes, very easy to see them as synonymous or one and the same. Please recognize that they are very different. So at the start of the year, we expected a better than expected economy. That now, where we sit in the half of the year, we still believe that economic resilience stands strong. We do see a shift from the Federal Reserve leading us into higher for longer interest rates, which could create some type of difficulty within the market, which the second theme at the start of the year was lower or below average returns for the market. And then the third theme is volatility is back, exactly what Robert said. We have a few points to share on that volatility piece. So Mike, if you'd like to walk us through our first theme for the evening.
Yeah, Marcus, as you just mentioned, starting with economic resilience, entering the year, We thought the economy would perform better than many expected. It's remained resilient through the first half of the year, and we expect that resiliency to continue in the second half. Although outside of the economy, when we talk specific on markets, which we'll talk about a little bit later, we do expect to see an uptick in market volatility, especially with the midterms and the election cycle coming. Um, in terms of that economy through the first half, as I mentioned, it's been resilient. A lot of numbers and charts here, but basically what we're looking at here is manufacturing and services. They both appear to be on very solid footing right now, and are currently in expansion territory. So that is a positive for the economy. Moving along, economic surprises. Surprising, the economic index has been positive as well, and you can see it's been surpassing expectations for the year. U.S. retail, or excuse me, consumer strength. You and I, Robert, myself, and everybody on this call, we're all consumers. And together, our spending habits are a large part of the strength of the economy. When Robert goes to Costco for the big, bulky paper towels and ends up leaving with a kayak, or Marcus tomorrow when you have the surprise gift from Amazon that arrives after tonight's late night impulsive decisions, we're collectively helping the economy be strong. These may not be the best decisions for your families, but our spending is helping the economy grow. Consumer spending right now makes up 70% of the GDP of the US economy. That's gross domestic product. Year over year, retail sales remain strong, and this strong consumer spending has carried the economy. So, congratulations, everybody. Not only has consumer spending been good this year, capital spending has been a strength as well. Just like you and I spend money on goods and services, businesses also spend money, and businesses have been investing. While recent gains have been supported by AI and technology, you'll see in this chart everything tends to be moving on an upward direction, and that upward direction suggests that demand is increasing in the economy for capital spending. Why is this happening? Well, you'll notice on the next slide that inventories, and we talked about this at the onset of the year, inventories are low. During the pandemic, in the low interest rate environment, many businesses loaded up on inventories because they could buy things at much cheaper prices and build those supplies. As those supplies built, interest rates went up, and as interest rates went up, they were able to work through that excess inventory. Well, what we're seeing now is we're seeing those inventories decline, which means businesses will need to continue to spend and invest. This would also be a positive for the economy. Back to you, Marcus.
So we should all give ourselves a round of applause for our contribution to the GDP. So shout out to me for those impromptu Amazon purchases. So as we look to the second theme, higher for longer, I'll say this is a slight shift from our original theme at the start of the year and even in the second quarter of the year. A lot of that is supported by a few things that we've seen in the economy and the marketplace. First is the Fed having a dual mandate, right? So typically we rely on the Federal Reserve to focus on their two primary tasks, which will be price stability and strength in the labor market. So as we came into the year, there was more focus on the Fed to not just control prices, but continue to watch the labor market. And as we've seen with tensions between us and Iran, a constant battle in Ukraine, those things added pressure to possible rate changes in the interest rates through taming inflation. So the labor force growth was weakening coming into the year, but what we've seen, especially with what Robert had mentioned at the very beginning of our conversation, the unemployment rate was fluttering around 4.2, which is still effective. So we're starting to see more stability in the labor market. Currently, I think you already highlighted that point. So 4.2, 4.3 was the unemployment rate. So the Fed is beginning to shift their attention back on inflation, possibly not over focusing on the unemployment rate or the labor market. Now, how are they watching inflation? what you've heard so far, again, Robert mentioned year over year inflation in May, around 5%. And as of June, we've seen a downward tick down to 4.5. There are many different measures of inflation, right? And what you'll see later in the slides are there are things that we're tracking like core CPI, PCE, and plenty of other measures. What you can see right here with the CPI, the Fed's target is typically 2. We are elevated past that, still about 2.8 as far as core CPI is concerned. But that with where you may see movement in the market, especially in correlation to our conflict with Iran, is centered around if there is an uptick in inflation with our cost of goods and services. So the war with Iran caused energy prices to soar. While it has limited impact to consumer inflation, underlying wholesale inflation is rising. So not necessarily immediately impacting the consumer, but we are seeing businesses being impacted by this. So one thing that the Federal Reserve may watch is the PMI, the prices index, which are affecting manufacturing and servicing businesses. So it's a wholesale level that they'll be watching in addition to the CPI and the PCE. One thing that is good for the Federal Reserve, maybe not so great for the labor market, is slowing wage growth. Now, slowing wage growth is something that typically sticks. It's not a fluctuating thing, i.e. as employees are increasing their wages. That's something that typically sticks for businesses to have to pay. So why that's a good thing for the Federal Reserve is as slowing wage growth could signal that companies may have to watch their profits and earnings, which could be a reason for them to cut interest rates to stimulate the market. But right now, they're still watching inflation. There is a chance that they may increase interest rates. As far as for the yield curve, this is something that isn't immediately affecting stocks, but it does impact the bond market. Bond markets are interpreting that inflation caused by the war to be transitory. So longer maturity bonds, more so signaled by the 10-year Treasury. Longer maturity yield bonds have not risen as fast as short maturity bond yields. This has flattened the yield curve, but gives us insights into what investors are thinking. And so what this chart is really signaling is that the yield curve, which is the separation between the yield on 2-year Treasuries and 10-year, they're starting to flatten, signaling that investors are expecting these current interest rates to stay higher for longer. Now for the third theme, which focuses on volatility. Simple note here is follow the earnings. We've had wonderful earnings seasons throughout this part of the year for 2 straight quarters. Companies have met their earnings. And with appreciating stock prices, that also leads to appreciating valuations. Where this can be a risk is as we continue to go through the year, if there is a chance that companies do not reach their expected earnings, with higher valuations could lead to a drop in the value, thus a correction or a drop in the market. So we had great earnings seasons. When prices go up, earnings expectations also increase. Again, always follow the earnings. Another thing that can lead to volatility in the market is that we've had a change in the leadership of our Federal Reserve. There's a new Fed chair. His name, Kevin Warsh. He's looking to make changes to the way that the Fed operates, including less forward guidance and creating task force to reimagine data inputs. The markets can't assume historical Fed reactions. Kevin Warsh has a different approach to what data is included and how he's going to be moving with said data. So not looking at the dot plot is one big difference. Another thing is emphasizing price stability above all else, leading back to what we mentioned before, possibly the Fed not focusing as much on the labor market, but focusing more on inflation. And that can lead to a different type of historical reaction than what was done before. As an example of information that may be focused on, there may be a new preferred measure of inflation. As I mentioned before, you heard CPI, you've heard PCE. Now there's a different measure that they're going to be looking at possibly, which is 16% trimmed mean CPI. What that does is it strips out the top and bottom 8% of the CPI category, and it takes the mean, the average of what is left. So it aims to be a less volatile metric, which could be possibly where we see a different call to action in the Federal Reserve. So another thing that can lead, which we've to this point seen, the end of the ceasefire and the war between us and Iran. Geopolitical risks are always there, but will remain heightened for some time. We still have the war in Ukraine, as I mentioned before, and any peace deal with Iran could be short-lived, reigniting tensions, and Iran could lift energy prices higher again. And we're in a midterm election year. Now, that's not new. We have seen this plenty of times before. We do expect political rhetoric to be high. While we don't think it's to have a big impact on markets, this could add to volatility around that time of year. So a few reasons to be positive or optimistic about the volatility. Anytime you have volatility, it creates great entry points for long-term investors. As we talked about valuations being high, if we do see a pullback in the market, that is a perfect buying opportunity for long-term investors. Also, a reason to be optimistic is we've had strong run-ups in the market. Possibly now is a wonderful time to recognize your gains and possibly shift your risk tolerance or your risk observation and capitalize on the gains and possibly lock those in some other type of vehicle. The economy is also still on solid footing. So we're not quite expecting a recession to occur over the next 6 months to the next year. We always want to remind you that corrections in bull markets are normal and typically they're short-lived. This also fits into our theme at the start of the year. A pullback could propel quality stocks higher and increase market breadth. Now, what you're seeing here is a 200-day moving average as a percentage of stocks. And what we're going to be highlighting in a few other slides that gives us a lot cleaner view of explaining this. But we're going to be talking about market breadth, which touches back to what Robert mentioned about concentration risk. So as always, we thank you for sticking with us to this point on that more in-depth level of the macro econ. But Mike, I want to pass it back to you to give us some principles and actionable things to keep in mind with all the data that we just covered.
Yes, thank you. If you could help us out here by bringing up a couple of slides. So one of the things we want to do is we always want to make sure that you have some takeaways and some things that you can have as far as discussion points with your advisor. If there's concerns that you have, give you some data here to take with you that might illustrate some of those points. So, this first chart that you're seeing here is just a very simple chart that shows the overall direction of the S&P 500 index. Again, the S&P is the 500 largest companies that are on Wall Street today. As you can see, as of yesterday, the S&P closed at 75.72, which is nearing, if not an all-time high, very close to an all-time high. Obviously, since the pandemic in 2021 and the interest rate hikes in 2022, we are up 112% since October of 2022. So the market's had a very nice run. That's not to say there haven't been a few pullbacks along the way, but mostly in a positive direction. Reason why we bring that out is if you've ever been in a ship and out on a boat, you might know that when you look over the side of that boat, if the waves are rocky, it could make you sick. As you look out, though, at the horizon, what they tell you is for seasickness, look as far out as you can at the horizon, because when you look out on the distance, everything's very flat. Well, if you're looking at the green line, I want you to think of being on the ship looking at the horizon. If you look at from October 12 of 2022 to July of 2026, you see a fairly straight green line going up. Along the way, though, if you're looking over the side of the boat, you would have seen all these ups and downs. So that's that short-term focus, and the green line's the long-term focus. Very important when you remember when we're handling stocks and anything that's market-based, we want to keep that longer-term perspective. Next slide, please, Marcus. Robert alluded to this on the onset, so I'm not going to spend a great deal of time walking through here. But what you'll see is as of July 26th, the 10 largest companies on Wall Street. And what you'll notice is in the S&P 500, as Robert mentioned, those 10 companies make up right now nearly 40% of the entire market capitalization. What that means is those 40%, those 10 companies are so highly concentrated that a lot of the performance of the S&P has been based on the performance of just those 10 companies. Now, if you'll notice, there were two new additions recently to those top 10, Eli Lilly and Micron. We do see some changes from time to time, but this is an area that we've been looking at. Next slide, please, Marcus. This is definitely an area we've been exploring. Throughout the year this year, we talked about it on the onset. Market's up 11% year to date. However, if you notice that little red dot there, if you're just looking at returns and you think, well, we're up 11, that's been good. It's important to remember at one point this year, we were down 9. So from 9 to 11, that's over a 20% difference. So when we say markets will move up and down, you notice almost every single year, there's a point in time during the year that the markets are down. Many of those years, however, the market actually finishes up by the end of the year. And that's why we don't want to be impulsive and be reactionary to events that are occurring day to day, month to month. We want to keep those long-term telescope goggles on, looking out as far as we can to ride out those ups and downs. Next, Marcus. We, as investors, are emotionally tied to our money. And based on things that are going on around us, we are sometimes more or less confident in what is going on. The chart that you see here shows consumer confidence and the stock market. So what you're going to notice is when confidence is low, for example, if you look at June of 2022, consumer confidence in June of 2022 was at an all-time low. It's kind of below you. There it is. 17.6. But if you notice the economy and the market in the 12 months that followed, when confidence was at an all-time low, the return of the market, you would have seen a 17.6% return in the 12 months that followed. Interestingly enough, when the markets were, when consumers were confident, so if you look, for example, at one of the all-time highs there, let's just go back to January of 2007, consumer confidence was fairly high, but the net return of the market in the 12 months that followed was negative 4.2. So sometimes what our gut tells us about the markets isn't really in reality what lies ahead. A lot of times our gut is based on more recent events that have occurred and the environment we're in today, not where we're going to be, which is why we say if there's something on your mind, you should be hearing from us. But if you don't hear from us for whatever reason and something's on your mind, give us a call. We will walk you through it, and our job is to help you understand what lies ahead while we're trying to make sense of what's going on around us today. Next slide, Marcus. Here's how we do it. Well, diversified portfolios is important. Again, I'd love to tell you that we knew exactly what area of the economy was going to perform the best every year. But there's nobody in the world, Warren Buffett included, that can put their finger on that year over year. So if you'll notice, there's a lot of colors, but if you follow the colors, what you're going to see is some of the colors at the top. For example, 2025, U.S., what does that say? Emerging equity, EM equity?
Yep, emerging markets.
Was up
emerging equity.
34%. The year prior, notice it was more in the middle. In 2023, towards the lower part. In 2021, it was the worst performing sector. Oftentimes, the sectors that perform the worst are some of the best performing sectors the next year, and some of the best performing areas of the economy or market end up becoming some of the worst performing. So what do we believe in? We don't believe in chasing performance. We believe in tried and proven strategies by diversifying you across asset classes. And if you'll notice here, looking at that, the white boxes shows a nice 60-40 mix of different asset classes across the board. Notice that you may not be the highest performing out of all of them, but you're also not the lowest. And over time, you're still able to make money with a little bit smoother ride. And most people prefer the smoother ride over the huge swells out there in the Pacific or the Atlantic. Next.
If I may, before we move on, because this slide really does touch a lot of things that were mentioned earlier, right? So,
Mhm.
at the very beginning, you heard Robert mention where we are year to date for the S&P, the Dow Jones, and the Nasdaq, right? And all of those are specifically the United States market, but they all make up different types of companies. Um, if this were a roulette game, I'll just ask you guys, but I like roulette. I don't gamble much. I don't gamble often, but when I do, I try to win in roulette. If you walk into the casino and you saw this sequence of colors, what are you placing your next bet on?
I have my
No,
favorite numbers, so I usually place about 13 bets right in the middle and hope for the best. But I don't know what you would do there.
hope for the best, right? You try to diversify, but as you can see, there's truly no sequence, right? So that also speaks to the value of allocation, right? There's no perfect way, there's no rhythmic pattern to what is going to be the next leading thing. You don't quite know what numbers it is going to hit. Secondly, as we talked about concentration risk, right? You just mentioned in the market, we have 10 companies that make up 40% of the growth among the S&P 500. Thankfully, the S&P 500 is not the only thing that we have to invest in. As you can see, emerging market, developed market, large cap, which can be represented by the S&P, but you also have small cap, commodities, high yield, fixed income. There are a lot of different asset classes. So I just wanted to, double down further on that to just give a visual example of what we talk about when we say diversification and how we can address concentration risk, how we can diversify out of just the top 10 companies, how we can diversify out of artificial intelligence, because concentration risk is a real thing, and I'm not sure many investors are fully aware of that. Appreciate that. And then last slide for you, Mike.
Go ahead, man. Yeah. So you can cover this one. This talks about retirement funds. Robert touched on the fact that 3 out of 10 people have no idea how they're allocated in funds. But you want to touch on this for us, Marcus?
Reason I really enjoy this slide is for some people in their retirement is comprised of things like a pension, whether it's federal government, state government, maybe a corporation, also could be Social Security. And then there's other monies that they may have invested. Really, the thing that I always like to highlight is that defined benefit plans, which are pension plans, even those plans have to meet their obligations, right? Same old, concept from the Social Security Act, man. You have revenue that comes in, you have expenses that go out, but then there's typically extra money that's left over that needs to be invested to meet the future obligations of its participants. So one thing that I just like to highlight is even your defined benefit plan, if anyone's part of a pension plan, understand that they're even investing monies for your future in retirement. So there's revenue being raised from employees paying into it. Social Security is the same concept. You have people paying taxes into the system. But then there's money that's stored for future expectations. One thing that we do notice is on average, you can see how much equity they would typically have invested. The extra money that's not being paid out immediately, you typically would have about 58% in equity, 38% fixed income. As of most recently, we've seen a shift, right? Maybe they're not in a risk on position. They're more balanced 50-50 between stocks and bonds. But this part, for the average person in a defined contribution plan, you can see the disparity, right? Now, this is a very broad spectrum. You have many different types of participants in an employer-sponsored plan or defined contribution plan, whether they're young, early accumulators like myself, or if you're soon retirees. You can see on average, there's a lot more equities being held within defined contribution plans. And you can start to see, again, hurting, right? Possibly because of great run-ups in the market. You have people possibly taking more risks than necessary. And those are just a few things that grabbed my attention from this one. But I'll pass it back to you to close it out.
Yeah, no, I appreciate you covering it. And I know there's a lot of information to go through. Robert, do you have something you wanted to add?
Yeah, on that slide, I think when you look at it, when when people you hear like what Marcus covered there about private defined benefit plans, we're talking like the Virginia retirement system that pays a pension check each month to, retirees. And the fact is you have to be allocated and invested to keep up with inflation. But you can see it's kind of a 50-50 type situation. The point is when Marcus pointed out the numbers on the right, everybody is flocking to probably an overweight. Unless you're a real young person, people may have too much concentration wealth because of the fact of how much the markets run up, specifically around certain types of stocks in the S&P 500. And the time to make those adjustments is when you're up in the game, not when you're down 20 or 30%. I was going to ask you, Marcus, to go back, or Mike, to page 9 of this great document, the JP Morgan Guide to the Markets. And that chart that Mike's got right there, right? If you look all the way to the right in July of 26, and you see that big stack of companies, NVIDIA, right, with the super chip technology they have, Apple, Alphabet, Google, Microsoft, Amazon, Broadcom, Micron, Meta, every single one of them, including Tesla to a certain extent, is all based on the premise of how far AI is going to run. And it's run up dramatically. So the bulk of that run up is in basically 9 companies, and it's all around one theater or one sector, AI. So we better hope we don't get any bad news in that arena, because outside of Eli Lilly, that makes great oncology, cancer drugs, and diabetic weight loss drugs and Alzheimer's drugs, that is a straight sleeve for a Tower of Babel of AI, which is fine, but many people don't know they're taking this level of concentration risk. And you got to be aware of it, because if something's run up the most, that's probably where we're going to see the greatest volatility going forward.
And to that point, what that really means is that all funds are not the same. You could have a large cap fund that invests in more dividend paying companies focused on the other 490 companies that are in the S&P 500 versus one that broadly just brings in all 500 companies. If you're able to do that, and that's again what we do behind the scenes when we build portfolios and when we manage your accounts and when we work with the investments, part of what we're doing is we're making sure that we can diversify you away from some of this risk. Again, we still want to give you exposure there because these companies have grown and been very successful. But there's other companies that are out there that can be just as successful over a long period of time too. So I know again, this is a lot of information, a couple closing thoughts, and then we'll wrap up here is, first, if you haven't taken some risk off the table, so for the last 2 or 3 years, markets have been up since basically 2022. If you're up 20, 30% on a $500,000 portfolio, 20% is 100 grand. Do we want to keep all 100 grand completely exposed to market volatility, or should we look at perhaps pulling some of that and moving into a place that's a little safer? That would be a conversation to have with the advisor. A lot of factors go into that: age, timeline, risk levels, all sorts of different things, but it'd be something to look at. 2, are there opportunities to diversify into other areas? And 3, have we addressed other planning needs? We're spending a lot of time today in this market outlook talking about obviously markets and investing. That's one piece of the puzzle. But part of that plan is making sure there's other pieces in place. Do you have guaranteed income streams? Do you have protection? Have you considered what might happen in the event of a long-term care event? So if you haven't taken the time, it's a great time of year as we move through the end of the summer into the fall to kind of just take a quick time out. Let's reassess where we're at. Call it's halftime. Let's go into the locker room, make whatever adjustments we need to make during halftime, and come back out to have a strong second half and make sure you're set up for success. So, Marcus, I've asked you this question before. Let's see if you can remember. What's the clock's favorite time?
12 o'clock.
6:30, hands down. We're a little past 6:30. I know we want to finish up, We thank you for joining us today. We hope to see you again in the fourth quarter when we come back with the fourth quarter outlook. In the meantime, enjoy the rest of the summer. Stay safe. We're here if you need us. Don't hesitate to give us a call. Thank you very much.
Thank you. Good evening.
Bye.